Okay,
The
so
internet issues solved now, yeah?
sorry.
The internet issues are solved?
Yeah, much better. I've been taking the classes since morning. It has not created trouble till now. Now let's see what happens with you. So in the previous class, we started our discussion on investment appraisal. And we discussed that there are different techniques for doing investment appraisal. One of the technique was net present value, which is usually one of the basic method. We discussed some basic things, that what are the assumptions of NPV relating to the cash flows during the year, cash flows incurred at the start of the year, capital allowance issues, working capital issues. Okay, and we did two questions in the class. One was Tricor company, and the other question which we did in the class was SC company. Okay, and then the third question which we were doing, but we left halfway around, that was Palta company, because it was an easy question. And one question I gave you as homework, that was Dan company. Yes. What do you want to
One
ask?
quick question on Delta.
Yes.
In the question, it just said, I just want to make sure I did it right. In the question, it said, the views of directors of Pelter Company are that all investment projects must be evaluated over 4 years of operation with an assumed terminal value at end of 4th year of 5% of initial investment cost.
Yes.
That is basically, I take that out as scrap value, yeah?
Yes.
Basically,
Basically,
in the capital allowance working.
in capital allowance working also, you will consider it as a scrap value, like while calculating the balancing allowance.
Yeah, okay.
Okay. So today we are moving towards another technique of investment appraisal, that is adjusted present value. Okay. Now it is one of the technique which involves some advanced adjustments. So I want you to concentrate on it so that you can have an idea.
Difficult.
A bit difficult technique, yes. As compared to NPV, it is, yes, it's difficult. Oh, just a second. Just a minute.
When is Sir Mustafa coming back then? Today
He's
or
coming back on Thursday. He will be back on Thursday, day after tomorrow. I think tomorrow now, because today is Wednesday.
I'll message him.
Now, when we talk about adjusted present value technique, the first technique which we did was NPV. Now, when we talk about adjusted present value technique, it uses some advanced assumptions and some advanced work methods which are more logical. Okay. Now, the first assumption which the adjusted present value technique uses is that it says that when we are financing the project, it says that NPV technique uses the WACC of the company for evaluation of the project. While you calculate the net present value through NPV technique, you use the weighted average cost of capital of the entire company. Adjusted present value technique says that this approach is wrong. It says that each and every project should be evaluated according to its own risk profile. Basically, it says that the company itself is a separate entity and the project is a separate entity. Okay. What the NPV technique do is that NPV technique uses the weighted average cost of capital, which includes impact of all other projects also. And then it appraises the project due through that weighted average cost of capital. Now, adjusted present value technique says that this is the wrong approach. The right approach should be that a project should be evaluated according to its own risk related rate of return. Okay, and then we should make the financing adjustments further. Now, obviously, the assumption taken by adjusted present value technique is more logical as compared to the NPV technique, because adjusted present value technique says that if the project is considered as an independent entity, obviously it will get financing according to its own risk rather than according to the risk of the company as a whole.
Basically, adjusted present value, basically the individual project has its own WACC.
The individual project will have its own risk profile, and based on that risk profile, you should calculate its cost of capital. Like, for example, I'll give you an example. Like, Mirchawala Institute has been running since 11 years. It has its own goodwill. It has its own stability. Like, for example, today we start our new business of, for example, making clothes. Now, making clothes has its own risk. The clothes business has its own risk, and it should have its own rate of return. Now, if I use the weighted average capital of the Mirchawala entity as a whole, then I'm giving it the credit which I have gained due to my teaching industry, due to my teaching experience. So adjusted present value technique says that this is the wrong approach. You should evaluate the project according to its own risk, according to its own risk adjusted rate of return. Okay?
Yeah.
Are you getting the point? So
Yeah.
let's write down some points. Let's write them. Just a minute. Oops. Yes. Now, let's write down some points so that you can have an idea. Adjusted present value. Adjusted present value. In this technique, project appraisal is done. Project appraisal is done according to rate of return, is done through rate of return, which is related, or I would say which is based on that project's own
Risk profile. Yeah.
which is based on that project's own risk profile. Okay?
Yeah.
In NPV technique, project appraisal was done. Project appraisal was done through companies WAC, which included impact of all businesses, which company was doing.
Yeah.
I hope that you are getting the point.
Yeah. Makes
Which
sense.
company was doing. Okay. Now, in contrast, APV technique assumes.
So normally in NPV they gave us the cost of capital, didn't they? Or
No, even if we calculate the cost of capital in NPV technique, we calculate the cost of capital by considering the company as a whole. We consider the capital structure of the company as a whole. APV technique says that this is the wrong approach. Why are you calculating? Now, if you remember the chapter of WAC which you have studied in your past studies of financial management, so you know the calculation of the WAC. In NPV technique, when we calculate the WAC, that considered the capital structure of the company as a whole. That considered the beta equity of the company as all of you, if you remember those beta factors of CAPM model. Okay. In contrast, APV technique assumes that project should be evaluated.
what is the
Through
cost of capital then in NPV? So like, where was that? Is that
the WAC, the weighted average cost of capital? The three questions which you did in which the nominal rate of return, that was the weighted average cost of capital of the company.
the
Now
discount factor? Basically,
that was given in the previous three questions, but you can also calculate it.
the discount factor.
Yeah, the discount factor. You discount the project through the weighted average cost of capital of the company.
Got it.
Okay. Obviously, the company evaluates the project by considering that what is my cost of capital and what is the return of the project.
Yeah.
Okay. Now, in contrast, APV technique assumes that project should be evaluated according to its own rate of return, which is based on its own risk. Okay, which is based on its own risk.
Yep.
Are you getting the point? Basically, APB technique says that the company will raise the finance from the market. The company will raise the finance from the market, and the company will make an investment in the project according to the risk profile of that project. Okay, are you getting the point? Now it is more logical. It is more logical and more justifiable approach.
More accurate.
So in contrast, APB technique assumes that projects should be evaluated according to its own rate of return, which is based on its own risk. Okay,
Yeah.
company will be 100% equity holder of the project. Company will be 100% equity holder of the project. Company will be 100% equity holder of the project, which is invested, who is investing funds in project according to project's own rate of return. Okay?
Yep.
Project's own rate of return. Now there is one question, that how to calculate project's own rate of return. So in order to calculate the project's own rate of return, we consider the industries in which are similar. We opt for companies which operate in the industry which is similar to the project.
Okay.
We evaluate the companies which are similar to the project which we are going to start.
Got it.
Okay, so project specific rate of return.
So this is how to calculate, then you're going to tell me how to calculate.
Yeah, project specific rate of return is calculated. Rate of return is calculated by considering similar companies, by considering risk of companies which do business similar to that project. Okay, which do business similar to that project. Are you getting it?
Yes, of course. Yep.
Okay. So what will be the process? We will first of all calculate the beta asset, the risk responsiveness, the business risk of the companies which are operating in that industry. And through that beta asset, the business risk of the companies operating in that industry, we will calculate the expected rate of return of the project. Okay. Beta asset.
So this is how to calculate the discount factor, the weighted the cost of capital here.
Yes.
Of the project specifically.
Of the project, yes. Beta asset, which denominates business risk. Beta asset which denominates business risk is calculated, which denominates business risk is calculated of similar company. First of all, you will calculate beta asset or the business risk of similar company. Through that beta asset, rate of return will be estimated. Rate of return of project will be estimated. Okay?
Yeah.
Now there are some more adjustments in adjusted present value technique also. Now, first of all, what did we discuss? We said that APB technique says that what we have to do is that we have to calculate project specific rate of return, and through that project specific rate of return, we will estimate an NPV. Okay, through that project specific rate of return, we will estimate NPV, which will denominate that project's risk. Okay, now NPV calculated through project specific rate of return is called base case NPV. Through project specific rate of return is called base case NPV. We call it as base case NPV. Okay.
Yeah.
That this is the NPV which is based on project specific rate of return. Now there are some financing adjustments are made. Now what are those financing adjustments? After base case NPV, some financing adjustments are made relating to project. Now what are those financing adjustments? Listen it very carefully. Some financing adjustments are made relating to project. Now, basically, the concept of the APV is that the company will raise the fund from market. The concept of an APV is that company will raise the fund from the market. Okay, and company will provide these funds to the project according to the risk of the project. I'm repeating it again. Company will take the funds from the market, whatever rate the company gets. That is the goodwill of the company. Maybe expensive, maybe cheaper. Company will take the funds from the market, maybe debt, maybe equity, whatever the company wants to do. And then the company will invest in the project according to the rate, the risk of the project. Are you getting the point? Now the project will operate, the project will earn. Once the project will earn, the project will give a return to the company. And that will be the return according to the risk of that project. From that return, the company will pay to its financiers, the debt holders and the equity holders. Are you getting the point?
Yes.
Now the project has made one valid argument which you have to listen. Project says that I earned a return and I paid that return to the company according to my risk. From that return, the company paid to the debt holders and the equity holders from which it raised the finance. Now the concern is that if the company has taken debt due to this project, so obviously the project will not pay any extra amount for the debt holders because the project has paid the return according to its own risk. Now it is the concern of the company to pay to the finances. But the project says that due to that, the company gets some tax benefit. The impact of that tax benefit should be given to the project because that is something additional which is earned by the company due to the project.
Okay.
Did you get the point?
So
the company said, okay, now you want to play with me. So the project said, okay, well, we want fairness. So the company said that in order to raise the finance from the market, we incurred some issue cost. We incurred some issue cost when we raised the finance from the market, which was for you. So you should pay that issue cost also. So the project said that, okay, if I would have taken the funds from the market, I would also have incurred the issue cost. So I'll pay for that issue cost. But on that issue cost, you get some tax benefit.
So the project wants the tax benefit should as well.
We want that tax benefit also. So the company said, fair enough, you take the issue cost and you take the tax benefit also. So now there are some financing adjustments which we have to make in the project. The first is the issue cost. The company is very fair. Company says that, okay, go and take the finance from the market. You will incur that issue cost. So if we are incurring it, you should also pay to us. So the project said, okay, if you will get any tax benefit, then that will belong to us. They said, okay. Now, if on the interest, the company will get any tax benefit, that will also be given to the project. Are you getting it? Now another thing. Now sometimes there are projects which are related to the areas where government gives subsidized loans. So the project says that due to us, the company is getting a subsidized loan. Because we are in the area which is subsidized. So the company said, okay, if there is any benefit of subsidized loan, we will transfer that benefit to you. Have you understood it?
I think so. So obviously the initial issue cost of obtaining the loan should also be
the funds, the finance.
Obtaining the finance should also be reflected, incurred in the project. The tax benefit the company gets as a source of obtaining the finance should also be incurred by the project. Number 3 was what was number 3? Sorry.
The company took loan from the market. So the company said, okay, give me the interest amount. So the project said, Have you gone mad? We are paying you the return according to the return of the risk of the project. So paying interest is your duty. It's not my duty. But
Yeah.
if you will get any tax benefit on that interest,
Tax
that will
benefit
be
of
ours.
interest. Yeah.
That will be
Okay.
ours. Because that is something which you are getting due to us.
Yeah.
And
Okay,
number
so
fourth is
tax
the
benefit.
benefit of the subsidized loan.
Okay. Got it.
Okay.
This is all to do with this is all APV, yeah?
Yeah.
Yeah.
After now, once we have calculated the base case NPV, some financing adjustments are made relating to the project. Okay. In APV technique, base case NPV includes impact of return which project will pay to company according to its own risk, according to project's own risk. Project's own risk. From this return, what will the company do? From this return, company will pay.
Project will pay to
From this return, company will pay to its financiers.
Finances, yeah.
Now, maybe the company has taken loan from the financiers at a cheaper rate. Now, that is the goodwill of the company. Now, that is not the goodwill of the project. That is the goodwill of the company, which the company, the head office should earn.
You're saying obviously the company, any return that the project makes, the company is going to use that return from the project to pay off its finances.
Yes, because that is the cost of capital. Now, any return above the cost of capital will also belong to the company, but that is the net profit of the project.
So that's basically cost of capital is basically how much, what is cost of capital? Cost of capital is...
It's very simple.
Sorry. Cost of capital is basically the cost incurred to obtain finance, basically.
Now, sometimes this cost is not incurred in actual. Sometimes it is an opportunity cost. Like, for example, if I'm investing in a project, listen very carefully, and that project is very risky. So it is my right to earn greater return because I'm taking risk of my funds. Maybe I haven't taken those funds from the market and those are my internally generated funds. But still, if I'm taking the risk, it is my right to get greater return.
Yeah.
And the same thing the company says. The company says that these are our funds. Go and raise the funds from the market. So now basically APV technique is based on separate entity concept. The company is separate and the project is separate. Okay. Despite that project is part of the company, but APV technique says that consider both of them separately.
Got it.
Okay. And it is more logical technique of investment appraisal because in this way you will get an evaluation which the entire market would have been doing. Are you getting the point?
Yeah, got it.
Now, what the company did in base case NPV, company charged the rate of return from the project, which is based according to the risk of that project. That the company got the return. From that return, the company will pay to its financiers. Okay?
Yeah.
Now, number two. If the company has taken, if due to project, debt capacity of company has increased. If due to project debt capacity of company has increased, then project should get tax benefit.
Yep.
Should get tax benefit of interest expense on debt capacity. Okay.
So the project gets this was number 4 though, number 3.
There is no mandatory list. Okay. Now I'll ask you one question. The company says that why don't you pay interest expense yourself? Why should we pay the interest expense and you get the tax benefit? Why? Why the project is not paying the interest himself?
Because technically it's the company that took the source of finance.
So is the project paying anything against it?
No.
Yes, the project is paying the rate of return according to its own risk.
Oh, yeah.
The project says to the company that, sir, I have paid you a rate of return according to my risk. Now that is your cost of capital of investing in me. Now it is your concern that you take finance from wherever you want. I have paid you a cost of capital. To the debt holders, but the tax benefit which you are getting is something else. So that benefit we want. Okay.
Got it. So the cost of capital of the company investing in the project. No, sorry, the project making a return on top of according to its own risk profile is the cost of capital.
The risk of the project is used to calculate the cost of capital of the project. Cost of capital. If the project earns anything above that, that is the additional profit of the project. That is not the cost of capital.
Okay, yeah.
I am repeating again. For example, if a project has a risk of XYZ amount, and considering the risk-free rate and market rate and considering the risk, I calculate that the cost of capital of that project is 12%. So I invested the funds, and the 12% which I am taking is the cost of capital of the funds which I have invested. Now, if the project generated actual return of 20%, now that 8% is my profit above the cost of capital. Now don't think about that 8%. Think about the cost of capital. Through that cost of capital, the company will pay to the financiers.
And when you say cost of capital, you're basically saying that to invest in the project.
Yes.
Yeah, okay.
For example, I ask you that invest the funds in our institution. So what you will do, you will look at the risk-free rate which is going in the market. You look at the market rate of return. You will look at the risk of our business. And you will demand a certain rate, which will be your cost of capital. You will say
cost
that I want at least this cost. I want at least this rate. Now, this is my cost of capital. If I will get anything above that, then I will consider it as my profit.
Understood. Okay, got it. Yeah.
Now, if due to project any issue cost, if due to project company incurs any issue cost, for raising funds, then project should bear that cost, because project has not paid anything against the issue cost yet. Okay, then project should bear that issue cost, Okay.
Yeah.
However, if this issue cost relates to debt, if this issue cost relates to debt, then tax benefit on it, will be included in project. Okay?
Yeah.
In project. One last thing, if due to project any subsidized loan is obtained, then benefit of it should be given to project. Okay?
Yep.
So, before moving towards the question, let's revise it.
This is a bit tricky.
Sorry?
This is a bit tricky.
Yeah, it is tricky, obviously. But you must have studied it in your past studies.
Maybe
have you studied APV?
A long time ago.
But have you studied APV or you just studied NPV?
Let's have a look. I think
Because usually in basic financial management, there is no APV.
Yeah, I don't think I've done APV, you know.
Okay.
Yeah, I've not done APV.
So now it is an advanced technique and it is more logical. Now, if you have studied advanced financial management, then it includes this always. Like in ACCA also, the students who have just studied basic financial management paper, they haven't studied it. Okay. Now, so when we talk about adjusted present value, it is a technique which says that while evaluating the project, only consider the risk relating to that project first and calculate a base case NPV. Now, once you have calculated the base case NPV, keep it in your mind that this is the NPV, which is according to the cost of capital of the project only. Okay. Now, there are some financing adjustments. There are 4 financing adjustments. First of all, if any issue cost is incurred, take the impact of it. Issue cost, if any tax benefit is obtained on that issue cost, take benefit of that also. 2 things. Number 3.
Yes. Number one was
Number 1, if due to raising funds, the company has incurred any issue cost, you have to take impact of that.
Yeah.
Because if the project would have raised the funds itself, it would have paid the issue cost.
Yeah.
If that issue cost relates to debt, then you must have got the tax benefit. Then that will also be recorded in the project. Number 2. Number 3, if the company is taking loan, then the interest expense which the company is paying, the company will pay itself because the project is paying the cost of capital to the company according to its own risk. But if on the interest expense, the company is getting any tax benefit, then that should be given to the project.
So the company, any finance cost, company would pay itself?
Yes. Because the project has paid the cost of capital.
Yeah. But if there's any tax benefit of the interest, the project will get that tax benefit also.
Yes. And if the project is in any area where the government is giving subsidized loans, then that benefit should also be given to the project. Okay?
Yep.
Now let's look at questions so that you will have more clarity. Again, now these will be the questions which will require focus and they will disturb you a bit. You will feel like you are studying SBM. Because last class was very easy and I thought you have become overconfident. Now, Fubiki company. Now, this is not the question of the SBM, it is a question of advanced financial management. But obviously, in order to practice APV, we have to do advanced questions. And similar questions then come in SBM.
So can you give me 1 second? I'm just going to go and get some water here.
Yeah. So, Fubiki company, an unlisted company based in Migira, has been manufacturing electrical parts used in mobility vehicles for people with disabilities and the elderly for many years. Yeah. These parts are exported to various manufacturers worldwide, but at present there are no local manufacturers of mobility vehicle in Migira. Retailers in Migira normally import mobility vehicles and sell them at an average price of $4,000 each. Fubiki company wants to manufacture mobility vehicles locally and believe that it can sell vehicles of equivalent quality locally at a discount of 37.5% to the current average retail price. Now the current average retail price is $4,000. And they believe that they can sell it locally at a discount of 37.5%. Okay. Yep. Although this is completely new venture for Fubiki company, it will be in addition to the company's core business. Fubiki company directors expect to develop the project for a period of 4 years and then sell it for $16 million to a private equity firm. Yeah. Migira's government has been positive about the venture and has offered Fubiki a subsidized loan of up to 80% of the investment funds required at a rate of 200 basis points below Fubiki company's borrowing rate. Okay, so we are getting the subsidized loan of the 80% of the funds at 200 basis points, means 2% rate below the FUBICI company's own rate. Currently, FUBICI company can borrow at 300 basis point above the 5-year government debt yield rate. Okay. Now, a feasibility study commissioned by the directors at a cost of $250,000. Now it is a sunk cost. You did feasibility study, but now it's sunk. Has produced the following information. Initial cost of acquiring suitable premises will be $11 million, and plant and machinery used in manufacture will cost $3 million. Acquiring the premises and installing the machinery is a quick process, and manufacturing can commence almost immediately. It is expected that in the first year, 1,300 units will be manufactured and sold. Unit sales will grow by 40% in each of the next 2 years, before falling to an annual growth rate of 5% for the final year. After the first year, the selling price per unit is expected to increase by 3% per year.
What is going on?
Basically, when we will start solving them, that is the scattered data. Basically, is stated that in the first year, the units will be 1,300. The unit sales will grow by 40% in each of the next 2 years, and then 5% in the final year, because it's a 4-year project. Now, this is not the difficult data. Now, that is only the scattered data. When you will start gathering it, you will get it. Okay. Now, in the first year, it is estimated that total direct material, labor, and variable overhead costs will be $1,200 per unit produced. After the first year, the direct costs are expected to increase by annual inflation rate of 8%. Annual fixed overhead cost would be 2.5 million. 60% are currently allocated overheads. Now, what do you mean by allocated overheads? Allocated overheads means the overheads which are irrespective incurred, and we are just allocating them. So that is an irrelevant cost, because that is the fixed cost which would have been incurred in any case. We are just allocating it to the project. Okay, like I'll give you an example. Like, for example, if you have a shop and you are selling 100 items in that shop, now the rent of the shop is fixed. So what you do is that you allocate the rent cost on each of the item. Now, if you add 101 item in that shop, you will allocate the rent cost on that product also. But that is not the relevant cost, because the rent would have been incurred on the 100 items already. Now, due to that 101 item, there is no incremental cost. Allocated cost is not the relevant cost, because it is committed and incurred cost. Okay. The fixed overhead cost will increase by 5% per year after the first year. FUBICI company will need to make working capital available of 15% of the anticipated sales revenue for the year. At the beginning of each year, the working capital is expected to be released at the end of 4th year when the project is sold. FUBICI company's tax rate is 25% per year on taxable profits. Tax is payable in the same year when the profits are earned. Tax allowable depreciation is available on plant and machinery on straight line basis. It is anticipated that the value attributable to plant and machinery after 4 years is $4 lakh of the price at which the project is sold. No tax allowable depreciation is available on the premises. FUBICI company uses 8% as discount rate for new projects, but feels that this rate may not be appropriate for this new type of investment. It intends to raise the full amount of funds through debt finance and take advantage of the government's offer of subsidized loan. Issue costs are 4% of the gross finance required. It can be assumed that debt capacity available to the company is equivalent to the actual amount of debt finance. Although no other companies produce mobility vehicle in Migira, Hyzon company, a listed company, produces electrical powered vehicles using similar technology to that required for mobility vehicles. Hyzem company cost of equity is 14%,
14%.
pays tax at 28%. Hyzem has 15 million shares trading at $2.53 and 40 million bonds trading at $94.88. The 5-year government debt yield is 4.5% and market risk premium is 4%. I'm saying it before starting this question, there will be a lot of learning in this question. And this is not your exam question that you feel shocked by looking at. This entire question will involve several learnings which will improve your understandability. Okay. 17 marks, we have to calculate the adjusted present value.
Yeah.
Okay. Now let's start it. Because it's a long question, so we have to look at it piece by piece. Fubiki company.
You've already scared me, sir.
The coming 2 classes are really scary because once foreign investment appraisal is also scary.
Is that the next one?
Yeah. That is also one which creates a bit difficulty.
So
company.
Are we not going to do payback period, IR, and Rocky and all that?
Those are very simple techniques. I keep them at the end of the investment appraisal so that once this chapter ends, you remain motivated. Fubiki company APV. Now, let's start by thinking. The project is of 4 years. If I remember, we read it somewhere here. Yes. The project is of 4 years.
Yeah.
Okay. So first of all, I will make a schedule year 0, year 1, year 2, year 3, and year 4.
Yep.
Okay. Let's look at the fact that whether tax is payable in same year or it's payable in arrears. Yes, tax is payable in the same year. Now, since the tax is payable in same year, so we don't need to make one extra year. Now, if you remember, what I do always is that I always deal with operational cash flows first.
You do the incremental cash flow stuff first, yeah?
Operational cash flows, not incremental cash flows.
Sorry, like operational, like variable cost, fixed cost, selling price.
On which there will be tax.
Tax, yeah.
So first of all, we will pick up the sales, workings, sales, working 1. Now there was some complex data relating to the sales. If you look at this note number 1, note number 2, there will be 1,300 units in the first year. And the unit sales will grow by 40% in each of the next 2 years.
Okay.
So first of all, let's put the sale units. Year 1, year 2, year 3, year 4. Sale units.
What's the sales unit in the first year?
How many units in the first year? 1,300 units in the first year.
Okay,
and grow by 40% in each of the next 2 years. And then 5% in the final year.
Yep.
So 1,300 in the first year.
So then that grow becomes 1820.
1820.
Then it grows by another 4%, 40%, sorry.
Yeah.
2548.
2548.
And then this grows by how much? 5%.
Yes.
2675.
So these are my sale units. Okay. Now let's look at the selling price. The selling price was, yes, if you remember, it was 37.5% discount to the retail price, and the current retail price was $4,000.
Yeah.
Remember?
Discount, okay. Discount 37.5.
So, and the selling price is expected to increase by 3% per year after the first year.
Okay, so first year we do
$4,000 into 37.5%. If I deduct it from it, 1 minus 0.375.
4,000 is 2,500.
Into 1 minus 0.375. Yes, it's 2,500. Now you have to increase it.
Increase it.
Yeah, by 3%, I think. Sales, your selling prices per unit is expected to increase by 3% per year.
Yeah, so then it's 2,575.
2,575.
Yep. 2,652.
2,652.
And again, it's 2,731. 2,732. Yeah.
So now you can get the sales. How much sales?
Oh yeah, okay. So we do 1,300 times 2,500 is 3.25 million.
So I can write it in 3250. I'm making working in 000.
Yeah, okay. Easier. Yeah, 2,575 is 4,686.5.
4,686. Okay,
0.5.
divide into 2,652. It's 6,5.
6,7. Huh?
6,5.
2,548 times 2,652 gives you 6,757.
Oh, sorry. Check the last one also, which I calculated.
6,757, yeah?
6,757.2. Okay, so these are my sales.
Yep, yep.
3250. 4,686. Then 6,757.
Yeah.
And 7,038. Okay, now let's move to note number 3. Now see, it's not difficult, it is just scattered and confusing, and student usually make errors. Now let's look at the direct material, labor and variable overhead cost, which will be $1,200 per unit. After first year, the direct cost is expected to increase by annual inflation rate of 8%. So 1,200 and then 8% every year. So working to variable cost.
So it's basically the same type of method of MPV.
Yeah, but there will be additional steps at the end.
Yeah,
the base case NPV approach is same.
Yeah.
Okay. Now in variable cost also the number of units will remain same. 1, 2, 3, 4. The number of units will remain same.
Yeah.
Now the cost per unit is, I think, $1,200 if I'm not wrong.
Variable cost.
Here it was written. In the first year, it is estimated that direct material, labor, and variable overhead cost will be $1,200. The direct material, labor, and variable overhead cost will be $1,200. After the first year, it is expected to increase by annual inflation rate of 8%.
Okay, so this is very, okay, yeah, so 8%. Okay, 1, 2 times 1.08 is 1,296.
After the first year, it will increase by 8% every year. 1,296.
1,399, 1,400, you can say.
And then
1,511.
So let's calculate the variable cost. 1,300 into 1,200. It's 1,560.
Yep. It's 2,358.7.
2,358.7.
Yep. 2,548. Oh, you do the next one. I'll do the last one.
I did the last one. 4,041.9.
3,564.6.
64.6. Okay. So these all are the variable cost. 1,560.
So you must spend a whole day in your room then.
Yeah.
You're in this room the whole day.
Usually for holidays. Nowadays,
Yeah.
the ACCA classes are stopped because in first week of September, the ACCA exams will be conducted. So currently, my only ICAEW batches and A levels classes are going on.
Okay, yeah, because ACCA papers are next week, aren't they?
Yeah, from the next coming Monday.
Yeah.
So in the morning, I have A levels classes, and then in the evening, I'm taking one ICAEW batch, which is in Urdu, and your one, which is in English.
What is the ACCA version of corporate reporting? It's called
SBR, Strategic Business Reporting. But in ACCA, that is easy because in ACCA, it is only a paper of reporting. But when you talk in ICAEW, it is reporting and auditing both.
Yeah.
But we hope that in Karachi, our schools and colleges, educational institutions will open by 15th. So let's see what happens because...
You're getting pulled out.
Yeah. Now I think that going to campus and teach is very difficult because since 6 months we have become lazy. 3, 5, 6, 4.6. So basically their educational institutions in UK are open or they are still closed?
Still closed. So colleges, everything. I think primary school and schools have opened, but college for this type of stuff is all online still.
Okay, so now we have the sales, we have the variable cost. Now let's look at the fixed cost, working number 3. Now when we talk about fixed cost, he said something here. Annual fixed overhead cost would be $2.5 million. Out of which 60% are centrally allocated overheads. Now they are irrelevant because centrally allocated overheads will be incurred irrespective. Okay. Now the fixed overhead cost will increase by 5% per year after the first year. So working number 3 is for fixed cost. Now.
So what do you do with fixed cost?
60% of fixed cost is irrelevant because it is allocated fixed cost which would be incurred, allocated fixed cost which will be incurred irrespective of project. Okay. Allocated means that is incurred irrespective. You are just allocating it.
Yeah.
Irrespective of project. Okay. So 40% of the fixed cost is relevant. I think it was 2.5 million.
Yes.
Let's look at it, just make a verification. Yes, it was 2.5 million and it is expected to increase by 5% every year. So 40% of 2.5 million is 1,000. Yep. So year 1, year 2, year 3, year 4. $1,000.
Increase by how much? By how much?
I think it was 5%. Yes, it's 5%. The fixed overheads will increase by 5% after the first year. So
1050.
1050. Then
1102.
1102.
And 1158.
Okay.
Yep.
1000, 1050, 1050, 1102 and 1158. Okay, so we are done with the sales, we are done with the variable cost, and we are done with fixed cost. So we have done the operational element. Let's look at it if there is any other operational cost. Okay, if you review the question, the first paragraph was on the project detail and the selling price. Okay. The second project paragraph gave us detail about the government subsidized loan benefit. Okay. And the scrap value of the project. Then the initial cost, sales, variable cost, fixed cost. Now then there is detail of working capital. FUBI company tax rate is 25%. It is payable in same year. Now tax allowable depreciation is available on plant and machinery. On that we have to record capital allowance because we have to calculate the taxable profits and the tax. Okay. And then I think there is detail relating to cost of capital. Okay. So the next thing which we need to do is we have to put the adjustment of the capital allowance and we have to calculate the tax. FUBI company tax rate is 25% per year on taxable profits. Tax is payable in the same year when the profits are earned. Tax allowable depreciation is available on plant and machinery on straight line. It is anticipated that the value attributable to the plant and machinery after 4 years is $4 lakh. Okay. Now, what is the value of the plant and machinery? The value of the plant and machinery will be $3 million on which we will get capital allowance. So let's record the capital allowances. Capital allowances working for. Now, capital allowances. Straight line basis on plant and machinery. Okay. Available on plant and machinery as per the question. On plant and machinery on straight line basis. Okay.
Yeah.
The cost of plant and machinery is, cost is how much? $3 million.
Yeah.
If I'm not wrong, the plant and machinery cost was $3 million.
Where did it say that?
The plant and machinery used in the manufacture will cost $3 million.
Yeah. Okay.
Okay. The project life is 4 years. Okay. Now, tax allowable depreciation is available on plant and machinery on straight line basis. It is anticipated that the value attributable to plant and machinery after 4 years will be $4 lakh.
So that's the scrap value.
Yeah. So I think it's simple. Life is 4 years.
So this is straight line basis, yeah?
Yes. And scrap value is $400. So capital allowance will be 3,000
minus
400 divided by 4 years. So it will be 2,600 divided by 4. It's 650 per year.
So is it, this paper, do you specialize more in this paper than CL?
Sorry?
Do you specialize in this paper?
I have been teaching this paper since a long time.
So but I'm asking because why, so does Sir Mustafa specialize in CR? And then you specialize in this? You all specialize in different papers?
Because Sir Mustafa has been teaching all the papers of the reporting in our institution.
Oh, so
he didn't give me this paper because I would have specialized in reporting also. I have a very diverse profile.
Yeah.
Now, so this will be my taxable profits. So let's sorry.
No, it's fine. So 3, 2. I'll start from year 4. Yeah.
Okay. 4686 minus 2358 minus
104.9
628
650. Last one is 1188.
1188 minus 3564 minus 1102 minus 650. So it's 1441. Okay, so now these are my taxable profits. We will
Now we do
simply
tax.
charge the tax. I think the tax rate is 25%.
25%. Arrears, yeah? Oh no, same year, same year.
Same years, so 25%. Now, it's 360 here,
297 year 4.
297. 40 into 0.25, it's 10. And then
157, 157.
157. Okay.
Yep.
Now we will reverse the capital allowance because it was only deducted for tax calculation.
Yep.
Okay. We are moving towards difficult adjustments. They are just a bit ahead. Because these all are the basic adjustments, 650,
Yep.
650, and 650. Okay, so now we are done with the basic operational level work. Now let's put up the investments. Let's deal with the working capital. Okay,
Yeah.
Now if I talk about the investment, so initial cost of the acquiring suitable premises will be 11 million and plant and machinery will be 3 million. So $14 million is the total investment which we require.
So
Investment.
you take that away in year 1?
Yes, year 1, 14 million.
14,000, yeah.
Okay. And then we have been provided with the scrap value of the project. If you
we
remember,
add that 400.
No, 400,000 is the scrap value of the plant and machinery.
Ah, shit.
Directors expect to develop the project for a period of 4 years and then sell it for $16 million. Okay. Now the entire project will be scrapped for $16 million. Now that includes the plant and machinery also. Okay. So the entire project will be sold for 16
So capital allowance
million
is only on
plant and
what you
machinery.
invest plant and machinery, isn't it? Yeah.
Okay. Now let's look at the working capital. The capital allowances we're working for. Now let's look at working capital. That will be something which will create a bit trouble. The working capital investment will be, okay, Fubiki company. Fubiki company will need to make working capital available at 15% of the anticipated sales revenue for the year at the beginning of each year. So we need working capital of 15% of the sales revenue at least. Okay. So.
Okay.
Working 5. Working capital. Okay. So basically he says that we need working capital of 15% of the sales revenue, year 0, 1, 2, 3, and 4. Now these are my sales revenue, which we already calculated. So what I will do is I will simply copy and paste it here.
Yep.
Now this is my sales revenue. Okay.
Yep.
Now working capital required. Is 15%. Oh, the space is ended. The working capital required is 15%.
Maybe you can do working capital one at the bottom. You can do it at the bottom. Take it left.
No, I'm very expert in this. I use this software for whole day. Working capital required. I've written at least 1,000 pages on this software since this corona. So my writing and control has improved a lot. So 3250 into 0.15 It's 487, which we require initially.
Wait. So you do 15% of what?
Of
initially?
sales revenue, 15% of the sales revenue.
Yeah.
Here it was written, working capital requirement, Fubiki company will need to make working capital available of 15% of the anticipated sales revenue for the year at the beginning of each year.
So obviously, sorry, for beginning of year 1, we'll do it end of year 0.
Yeah. Okay. Now, 4686 into 0.15. Here we require working capital of 702. Now listen it very carefully. If I make an head of movement,
Oh, incremental, yeah?
yeah, incremental working.
702
So here
minus
I
4
need
is
1487.
yeah.
But
216.
here I need just 216. Okay, then 6757 into 0.15. This is 1013. Or I would say 1014. So 1014 minus 703. So here I need 311. Okay,
Yeah.
then 7038 into 0.15. This is 1056 minus 1014. So here I need
105.
42.
Yeah.
Okay, and in the last year, the entire working capital amount will be recovered.
We add that up, yeah.
So 487, 216, 311, and 42. So it is 1056 that will be recovered. Okay, so 487 in year 0. Then 216, 311.
And 42.
216, 311.
42.
42, and then the last recovery is 1056. 42 and 1056 is the recovery. Okay?
Yep.
So I think that we have dealt with all of the cash flows. Okay? So now we can calculate the net cash flows of the project. Net cash flows. Now, basically,
the last one you've done 1056, that's positive. You've added that up, right? Yeah.
Because that is the working capital recovery at the end of the project. Okay?
Yep.
So 14,487, it is 14487 in year 0. Year 1 is 40 minus 10, 650 minus 216. It's 464. 40 minus 10, 628 minus 157 plus 650 minus 311. 810. Then 1441 minus 360 plus 650 minus 42. It's 1689, and 1188 minus 297 plus 650 plus 16,000 plus 1056. It's 18597. Okay? Till now, we haven't done anything which is related to APV. Now there will be the first adjustment which is related to APV, and that is the discount factor, because we will calculate the base case NPV. Okay? Year 0 discount factor is obviously 1. Now, for discount factor, I will make working 6, and that will be the thing which you need to understand. Working 6. Discount factor. Okay.
You got good writing, sir, because this is easy to print. I noticed when I printed out, it's perfect.
Yeah, I said that I have written more than 1,000 pages. I've written a lot. Now, basically, I use this iPad in my regular classes also. Like when I go to the campuses, I write on iPad usually. So my writing has get fluent on this. Last week, my iPad, the screen got corrupted. Now this is the iPad of Sir Mustafa.
Oh, okay. You went to his house and got it.
Yeah, I went to his home and I picked his iPad because he's in America and he's not. He left his iPad in Pakistan. My iPad screen got corrupted last week, so I have sent it for warranty claim.
Okay.
So my iPad is also confused that why are you using me so much? I use it like that 12 hours continuously. I continue writing on it.
It's part of your that's part of your job.
Yeah. So now when we talk about discount factor, now this is very much important. The discount factor in APV is the base case NPV discount factor, and that will be according to the project specific risk.
Yeah.
Okay. In APV technique, base case NPV is calculated. Base case NPV is calculated according to discount factor, which is based on risk of project. Okay.
In APV technique, base case NPV is calculated according to discount factor, which is based on the project.
Risk of project.
Yeah.
Okay. Risk of project under review. Will be calculated. According to risk of similar company, and that similar company in this case is ICAEW company. If you remember, according to risk of similar company.
Oh yeah. That has yeah.
Because that ICAEW company deals in ICAEW company is a listed company, produces electrical powered vehicle using similar technology that is required for mobility vehicles.
Yeah.
Risk of that project under review will be calculated according to risk of similar company, which is ICAEW company in case of this project. Okay.
Yep.
Now here you have to learn something that will be a bit difficult for me, that how I will reach the beta, because I hope that you must not remember the formula of the beta asset and the CAPM model. So now these are the things which you need to revise, and I will teach you them in the chapter of WAC also. Okay. Now listen it very carefully. ICAEW company cost of equity is 14%.
Yeah.
Its KE is 14%. It pays tax at 28%. ICAEW company has 15 million shares in issue trading at $2.53 each, and 40 million bonds trading at $94.88 per $100. The 5-year government debt yield is currently estimated at 4.5, and market risk premium is 4%. Now, always learn one technique whenever you deal with financial management. Try to solve it as much as you can. Don't get confused in the start. What I will do is I'm provided with the cost of equity. I'm provided with the risk-free rate, which is the 5-year government debt yield rate. And I'm provided with the market risk premium. So through this, I can calculate the beta equity of ICAEW company.
Okay.
Because if you remember the CAPM model, risk-free rate plus RM minus RF into beta equity.
Got it. RJ equals RF plus beta in bracket RM minus RF.
Now listen it. Now through ICAEW company, what I can do is, first of all, what I'm doing is, cost of equity is equal to RF, risk-free rate, plus RM minus RF
multiplied by
beta equity. Now this is the beta equity, not the beta asset. What I want is the beta asset. I don't want the beta equity. Now, what is the difference between that? Beta asset shows the responsiveness of the entire company assets. Now, that is the risk of the company. Beta equity is the responsiveness of the company's shares. I don't want
Okay.
beta equity of Hyzen company. I want the beta
Beta
asset
asset.
because the beta asset of Hyzen company will be the beta of my project.
What have you wrote there? RE.
BE, beta equity.
No. But the first
KE,
thing.
cost of equity.
Oh.
Cost of equity is equal to RF, risk-free rate, plus RM minus RF into beta equity.
Okay.
Now, basically I use this because I was provided with the cost of equity, which is 14%. I am provided with RF and the premium of 4%. So what I'm doing is cost of equity 14% is equal to RF, which is 4.5%. 4.5% plus 4% is the premium. Now, RM minus RF gives us the premium. RM is
Okay.
the market rate minus the risk-free rate. So that is the premium which the market demands.
Okay. So 4% is the premium.
And multiplied by the beta equity. So through this, I can get the beta equity 4.5 plus 4. Okay. So 8.5% multiplied by beta equity. Okay. So
What are you doing? 14% divided by 8.5%.
14%
Divided
the
by
14 minus 4.5. 4. Okay, I did something wrong, I think. Let's solve it step by step. 14% minus 4.5%. Okay.
divided by 4%.
Minus 4.5 divided by 0.04. So it's 2.375, sorry. Basically, I forgot to use the percentage. 2.375 is the beta equity. 14% minus 4.5% and then 4%
divided by 4%.
So 2.375 is the beta equity. Now I don't want the beta equity.
You want
So
beta
why did I
asset?
calculate it? I calculated because
you
that was the only available data and I started doing it. Now, when you talk about beta asset, how do we calculate beta asset?
It's a very good
Beta
question.
asset is equal to beta equity into E divided by E plus D into 1 minus T.
Wow, what is that?
That is the simple formula which you've studied in the VAC, and I will give you revision of VAC also. Beta dat into D into 1 minus T divided by E plus D into 1 minus T. Now, what is this going on? Let me give you a revision.
Please tell me.
Now, basically, when you talk about beta asset means responsiveness of the company's entire asset risk. Beta asset is the risk of the company's assets. Now, if you remember the accounting equation, assets is equal to equity plus liability. If I want the beta asset, I should solve equity and liability. Now, listen it very carefully. The assets of the company are not actively traded in the market. The assets of the company are not actively traded in the market. So you cannot calculate the beta asset of the company directly. Now, there is no market where you can get the beta of the fan, beta of the AC, beta of the table, beta of the chair, beta of the printer, beta of the laptop. There is no active market of all these assets. So in order to calculate the beta asset, what we do is that we first look at the beta of the equity, the shares which are traded in the market. And beta of the debt, the debentures traded in the market. When I weighted average the beta of my shares and the beta of my debentures which are traded in the market, I get the beta asset of my assets.
Okay, got it. Okay.
Now the question is that why can't you get the beta asset directly from the market? So there is no market where my assets are traded.
Yeah.
There is no market where my factory assets will be traded, where my debtors will be traded. So what I have to do is that I have to calculate the beta equity and the beta debt, because these are the two things which are...
Beta asset is basically the beta asset. What is beta? It's the
Beta
risk
asset
of the...
represents the risk of my company's assets.
Yeah. Okay.
Now this is the business risk. This is the risk of my company assets.
Yeah.
Beta equity is the responsiveness of my shares.
Yeah.
Beta debt is the responsiveness of my debentures. Okay.
Got it.
So now what I'm doing is beta equity into market value of equity, because I'm calculating a weighted average.
Yeah.
I'm calculating a weighted average. Beta equity into equity divided by equity plus the value of debt, which I've converted into after tax, because on that we get the tax benefit element. Okay. Now this is not related to APV. Now this is the basic knowledge of the VAT. Okay, we will revise them in VAT also. Now, so we need beta asset. We need beta asset. Beta asset is one which we need to calculate. We have beta equity, which is 2.375. Okay.
Yep.
Now we need value of equity. We need value of debt. Now what is the value of equity given if you look at it? Hyzon company has 15 million shares in issue trading at $2.53 each.
So we get 15,000 divided times 3.2. Was it
2.53.
2.53?
Yes.
It's 37950.
37950. 15 million shares in issue and $2.53. And what is the debt? 40 million bonds trading at 94.88 per $100.
Yes.
What is the value of debt?
And 40 million bonds trading 94
Per $100. So what you need to do is you have to divide it by $100 and multiply it by 94.88. 40 million bonds, $40 million bond, that is at par value.
40% times
40,000 divided by $100 multiplied by 94.88. If I'm not wrong. Yes. So how much?
37,952.
37,952. Okay. The rate of tax is 25%. We have everything. We have beta equity, we have E, D, T, everything we have. We don't have beta debt. What about beta debt?
Yeah.
Now, it is the basic assumption in financial management that beta debt is assumed as zero, because we normally assume that debentures are risk-free. So unless and until the examiner provides you any beta debt, you assume it as zero.
Okay.
Normally assumed as zero. Okay. So now I think we can calculate the beta asset. Beta asset is equal to beta equity 2.375 into equity 37950 divided by equity 37950 plus debt 37952 into 1 minus 25%.
Okay.
I'm repeating it again. Beta asset is equal to beta equity into equity divided by equity plus debt into 1 minus tax.
Yep.
Plus, now this bracket will be 0.
Yeah.
Why this bracket will be 0? Because beta debt is 0. So anything multiplied by 0
Yep.
will be 0.
Spot on.
So the beta asset will be
75%.
2.375 into
Plus
37950 divided by 37950 plus 37952 into 0.75.
1.357.
1.357 is my beta asset.
Wow.
Now this is the beta asset of Hyzem company. That beta asset is the risk of the project. Through this risk, I will calculate the cost of equity for that project, the rate of return of that project. Now, have some patience. This beta asset,
Wait, what do you mean?
Yes.
Oh, sorry.
This beta asset of 1.357 represents risk of Hyzem company business,
Yep.
which is similar to risk of project.
Yep.
Which is similar to risk of project. Okay, have you got this point?
Yep. So this would be the beta asset that we use for our project.
Yes. Now, as project will be 100% equity financed. As project will be 100% equity financed by company. As project will be 100% equity financed by the company is investing in the project, no?
Yeah.
As project will be 100% equity financed by company, therefore, it will be considered as beta equity of project. I'm repeating it again. Project is 100.
How have you assumed that we're investing 100% equity in?
Because the company is becoming the owner of this project. Company is investing the funds in the project.
Yeah.
Now, the risk-free rate was 4.5%. The market rate, the market premium was 4%. Premium is 4%. And beta of project is 1.375. Can you calculate the required rate of return of the project? The risk-free rate is 4.5%.
That's what we've been given, yeah?
Yeah, that was given in the question. We picked it from the year. We used it in the Hyzem company data also.
Yeah.
The 5-year government yield is 4.5 and premium is 4%.
Okay, so what's the formula now I'm using?
Sorry?
Am I going to do the same formula above?
I did same formula above for Hyzem company when I calculated the beta equity of Hyzem company. Because the risk-free rate and the premium will remain same. The beta value has now changed just.
Yeah, so I need to do the same formula again.
Yes, but earlier I was provided with the cost of equity. Now I will calculate the cost of equity.
Okay.
The risk-free rate is 4.5%.
Yeah.
The premium is 4% and the beta is 1.37%. So what will be the cost of equity you will demand from the project? 4.5%.
Yeah.
Plus 4% is the normal market premium and the project responsiveness is 1.375.
What formula is this? What are you doing? You're doing
CPM
the one
model, RF plus RM minus RF into beta equity.
Okay.
This formula is simply logical. RF is the risk-free rate which I can get from the government bonds.
Plus
The
4,
normal market premium is 4%.
and that's the beta equity. Okay, yeah.
The beta represents the risk of the project.
That beta equity or beta asset?
Basically, this is the beta asset of the project. But as the company will become the 100% equity owner of the project, therefore that beta asset will equal to beta equity because it is 100% equity owned.
Okay, got it.
Okay.
Got it.
So 4.5 plus 4 into 1.375. So 10% is the rate which should be demanded from the project at 100% equity financing. Okay. So through this, we will calculate the base case NPV.
This is ridiculous, isn't it?
909, 826, 751, and 683. Now, discount factors are picked from the discount factor sheet.
Yeah.
So these will be our present values.
Wow.
Still a long way to go because we
Yeah.
haven't done the financing adjustments yet.
And that's the whole APV bit.
Yeah, that is the basic concept. Now we have just done one thing, which is base case NPV till now. 464 into 0.909. It is 422. 810 into 0.826. It's 669.
Last one is 12701.
12701. 0.751 is 1268. So my base case NPV will be, I have sufficient space here. Base case NPV 14487 422 669 1268 12701. It's 573.
Yeah.
Okay, 573. Okay, so now we will make financing adjustments.
Why did you do that line?
Because our financing adjustments working will take till that long. I keep my sheets clean. Financing adjustments. Now, so the first financing adjustment is issue cost impact. Okay. Then we have tax relief on issue cost. Okay.
Yep.
Then we have tax benefit or tax relief on interest cost.
Yep.
And then we have benefit of subsidized loan. Benefit of subsidized loan. Okay.
Yeah.
So now let's start. So this will be working 7, working 8, working 9, and working 10.
Yeah.
And then we will get the adjusted present value. Now there are some small things which you need to learn here. Adjusted present value. Okay, now, so till now, if you look at it, the basic, till the net cash flow, it was simple old NPV. The first new thing which was related to APV was the calculation of the discount factor. Okay. Now, first of all, we will work on issue cost, working 7. Issue cost. Now, what about this issue cost? Let's look at it. Here he says, it intends to raise full amount of funds through debt finance and take advantage of the government offer of subsidized loan. Issue cost of 4% of the gross finance required. Okay.
Yeah.
Now, what is the gross finance required? In year 0, we require finance of 14487.
Yeah.
Okay, so let's look at it. Now, that is not the gross finance, that is the net finance we require, because that is the net amount we require. 14487. Now, that is the net finance we require. We need net 14487 in year 0. Okay? The issue cost is 4% of gross. Issue cost is 4% of gross amount. Okay? So how will you calculate this issue cost? 14487 divided by 96%, because it is the net amount, and then 4%. Because when I will add 4%, it will become gross 100%.
Okay.
Okay? Now, 14487 divided by 96 into 4. So it's 604. Okay?
Okay.
604 is my issue cost.
Wow, what is that? That is...
You didn't get it? 14487 is the net finance which I require.
Yeah.
4% of the gross amount is the net issue cost.
Okay, so that 14487 equals...
Is the net amount?
Is 4%.
No. 14487 is the 90s. This is the net amount which I need. If I will raise 14487 and then I'll deduct 4% from it, then my funds will get short.
Okay.
So I have simply grossed it up. Okay?
Yeah.
Basically, what I will do is 14487 divided by 96 into 100. I will raise 15090, and then from that I will pay the issue cost.
Oh, okay. So you gross it up first, then you take 4% from that gross.
Yeah. Then the working date, we have to simply consider the tax benefit on this issue cost, the 25%. Tax benefit on issue cost.
Wow, what
so
a question.
It will be 604 into 25%.
That 604 obviously 000, yeah?
Yeah. So the tax benefit on issue cost is 151.
That's tax
Okay.
relief, yeah?
Yeah. Done?
Yeah.
Now let's think about the tax relief on the interest cost. Because due to the project, the company will be able to raise debt. On that debt, interest company will get the tax benefit. Now that should be given to the project.
Yeah, the
Okay.
tax benefit. Interest, yeah.
Now here you need to learn something, and that will be
What's this?
just last things.
So you're killing me here.
Working 9. Tax benefit on interest cost. Basically, this is the first question which we are doing. Once we'll do 3-4 questions on this, it will be your hands-on approach. You'll be able to do it. tax benefit on interest cost. Now, if you look at the interest cost, what is the interest cost of the project? Now, basically, the interest cost element is Migira government has been positive about the venture and has offered Puviki company subsidized loan of up to 80% of the investment fund at 200 basis points below Puviki company borrowing rate. Okay, Puviki company can borrow at 300 basis points above the 5-year debt yield of the government.
What's this? This is the interest we're trying to work out.
The 5-year debt yield is 4.5%.
Mm-hmm.
So Puviki normally borrows at 300% above the 5-year debt yield. Now this is their normal interest rate. 4.5 plus 300 basis points means 3% added. So that will be 7.5%.
Okay.
And the government will give us at 200 basis points below the Puviki company normal borrowing rate.
So they're saying we'll give it to you at 5.5.
Let's look at it. Now, how much loan we are taking? Loan required is the amount which we need for the project. What is the amount which we need for the project? That is 14487. Okay. 14.
How is it 14487?
Because that is the net amount which we need for the project.
Okay, then okay.
Okay. We need for the project, we need 14487. 80% of the amount will be taken from the government and 20% will be through normal borrowing. Okay.
Yeah.
Now you have to look at it very carefully. Now what I'm doing is I'm calculating the interest. 14487 into 80% will be from the government and 14.
How do you know about this 80? Where have you got this from?
Yeah, it was written here. The government will give us 80% of the amount. Migira government has been positive about the venture and has offered Puviki a subsidized loan of 80% of the investment funds.
Okay. So what are we trying to work out?
Yes. Now, 14487 into 80% from the government and 20% is from the market. Okay. Our normal borrowing rate is 3% above the 5-year government yield. You remember? See, it was written here. Puviki company can borrow 300 basis points above 5-year government debt yield rate. Now, what is 5-year government debt yield rate? It's 4.5%. Okay.
So 7.5.
And what the government is offering me, it is offering me 200 basis points below Puviki company's borrowing.
Yeah.
Okay. So what I'm doing is that for my 20% portion, just a minute. What happened? Can you hear me?
I can hear you.
Okay, so 4.5 plus 3% is my normal borrowing, and in case of government borrowing, it will be 4.5 plus 3 minus 2%.
Yeah, so 5.5.
Okay. So that will be my interest expense.
Yeah.
I want the tax benefit amount, so I will multiply it by 25%.
Wow, okay.
Still, the main thing is not here.
Oh,
The finance amount, 80% from the government, 20% is mine. The interest, 25% is the tax benefit. Done?
yeah.
Now the most important question. Will you save this tax benefit in 1 year or you will save it over 4 years?
This will be over
Interest expense will be in each year.
1 year.
Interest expense will be in each of the 4 years. So tax benefit will also be in each of the 4 years.
Yeah.
So you have to multiply it by,
Oh, 4.
no. You
Oh,
have to
1 over 4.
multiply it with the annuity factor of 4 years so that you get the present value of this tax benefit. Okay? You didn't get the point. 14487 is my finance required. 80% is from the government and 20% is mine.
Yeah.
This is the rate of interest. This is the tax benefit. Now I have to multiply it with 4 years annuity factor. 4 years annuity factor so that I can get the present value of this tax benefit.
Okay. Okay.
Now the question is that what will be the rate of interest for that annuity factor? Will that rate of interest be of the base case NPV or will it be different? In order to get the annuity factor, you need the interest rate. What will be the interest rate on which you will get the annuity factor?
The base case.
No, the answer is that as it is a debt-related transaction, therefore we will pick up the annuity factor of the market rate of interest. The market rate of interest for us was 7.5%.
Okay.
I'm repeating it again. Now, this is the amount of finance we need. 80% from the government and 20% is ours. This is the rate of interest. This is the tax impact. This is the tax impact. Now we will multiply it with annuity factor.
Also, you'll do it for annuity factor of 7.5%.
Annuity factor of 4 years at market rate of interest.
Why do we do annuity? Because obviously it's consistent cash flow.
Why annuity? It is annuity because we will save this amount for 4 years. This tax benefit impact will be for 4 years. We will not save this tax benefit in 1 year. We will get this benefit in 4 years. Okay?
Got it. So what discount factor do we use?
Discount factor is for the benefit when it is for 1 year. Discount factor is for 1 year, annuity factor is for a period of years, and perpetuity factor is forever.
I know that. I'm saying what discount factor rate do we use? Discount rate.
Here we are using the discount rate of 7.5%, which is the market rate of interest.
Yeah. Okay.
Okay. Now see, I'm writing some explanation for you. Annuity factor is used.
Oh yeah, no, I know this. Yeah.
Is used because tax benefit will be gained for 4 years. Okay?
Yeah.
Will be gained for 4 years. Interest rate for annuity factor will be market rate of interest of debt as it is a debt related transaction. It is tax saving on the interest. It is a debt related transaction. It is tax saving on interest.
Yeah. Oh.
On interest on debt. Okay. Market rate of interest for Fubiki company is 7.5% of interest for Fubiki company.
And that's because they said that they offered us 200 base points below.
Now ignore the government subsidy. We need market rate of interest. So market rate of interest is 300 basis point above the 5-year government yield. The market rate of interest was 300 basis point above the 5-year government debt yield. Okay? It was above the 5-year government debt yield. Done? Now, how to get the annuity factor at 7.5%? Obviously, now we have to use the formula of the annuity factor.
Table.
Because no, in the table we can get either 7 or we can get either 8. We cannot get 7.5%. So here the annuity factor formula is given 1 minus 1 plus R minus N divided by R. So for 7.5%, 1 minus 1 plus 7.5% power minus 4 divided by 7.5%. Okay? So 1 minus 1 plus 0.075 power minus 4 0.075. So the annuity factor will be 3.34. Okay?
Yep.
Annuity factor at 7.5% will be okay, 3.34.
Yeah.
So, what will be the tax benefit of interest? 14487 into 80% into 4.5 plus 3 is 7.5 and minus 2 is 0.055 into 0.25 into 3.34. 144 into 7 into 0.8 into 0.055 into So this is 532. 14487 into 0.2 into 0.055 into 0.25 into 3.34. It is 133. Okay?
169.
14487 into 0.2 into, oh, sorry. Into 0.25 into 3.34. It's 181. Is that so?
No. Oh, sorry. It's 7.5%. 0.075 times 0.25 times 3.34 is 181. Yep.
713 is the tax benefit. Okay?
Yep.
Now the one last thing is the benefit on the subsidized loan.
Yep.
Okay, now there is nothing new in it. Benefit of subsidized loan. Hopes of subsidized loan. So how will we calculate the benefit of subsidized loan? Very simple. 14487.
Yep.
Now this is the amount of the subsidized loan.
That's the
The benefit rate is 2%.
Why 2%?
Because the government is giving it 2 basis point below. So 2% is the benefit rate. Okay. Now the one more thing, you are getting 2% lesser rate on the subsidized loan,
Yeah.
which means 2% lesser interest expense.
Yeah.
Which means 2% lesser interest expense.
Yeah.
So this means 2% lesser tax impact also. So make it 1 minus 25%.
Well, one second, repeat that again.
14887 is the total finance, 80% is the subsidized loan. You will get 2% less interest expense. So when expense will be lesser, tax benefit will also be adjusted.
So why have you done 1 minus 25%?
Because 25% is the tax rate. 1 minus 25% means that you will get 75% benefit of 2%. Because 25% will be the tax benefit loss. Multiplied by that annuity factor again, because this impact will also continue for 4 years.
Wow, okay.
14487 into 0.8 into 0.02 into 0.75 into 3.34. 580.
Honestly, you kill me. Today.
When you will use these techniques in your office, everyone will become your fan. And you will have logic of each and everything. At that time, you will transfer me double fees. That, oh, sir, I've got a promotion due to it. So 580 is the benefit due to subsidized loan. So my adjusted present value will be 573 minus 604 plus 151 plus 713 plus 580. So this gives me 1413. Okay. So what you need to learn is, I will say that in SBM, there will never be a detailed question like this. Never a detailed question like this will come. In SBM, there will be small adjustments involved from it.
But this obviously helps us understand every single possible way of every type of adjustment.
You are understanding the complete process. Try to understand it logically, that you remember the logic of each and every step. Now, basically, the sales, variable cost, fixed cost, capital allowance, that was a clerical work. Working capital was also not difficult. That is simple, basic financial management. But the real concept starts from here, the discount factor. Why do we use discount factor of the project? So that we can get the rate of return which is related to the project. This 10% is the rate of return which is related to the project. Considering that the base case Npv is, sorry.
That was the 10% we worked out. Oh yeah, as the beta of the project, yeah.
And that 10% was calculated through the beta of the project. So that represents the risk of the project. And then we did these 4 financing adjustments, and there is logic of each and every adjustment. The impact of issue cost, because if the project would have raised funds from the market, it would have paid the issue cost. If the issue cost is related to the debt, you will get the tax benefit. Here, the entire project was debt financed. It was stated that the company will take funds through debt. Okay. The impact of tax benefit on interest cost and the benefit of subsidized loan.
What did you say about debt? So because we worked out beta asset, and because we 100% financed, it was sourced from debt. That's why beta asset equals beta equity.
Yeah. This was what we done here.
Yeah. So that basically, that's why beta asset equals beta equity.
Yes. Because the company will become the 100% equity owner of this project. So for the company, this beta is the beta equity, because the company will become the equity owner. Now, from where the company will raise finance, the company will raise finance through debt. See, this is Fubiki company, which is 100% equity owner of project.
Yeah. Got it.
Okay. And the company will take 80% debt from government.
Yeah.
And 20% debt from market.
Got it.
The company is using debt, but as far as the project is concerned, the company is the 100% equity owner of the project. Okay, so give it some time, revise it, so that you can have a brief overview. In the next class, we will do 2 more questions on it, so you will have more clarity on it. And then
Okay.
I will move towards foreign investment appraisal.
Next class tomorrow, yeah?
Yeah. Okay.
You'll send me this, and you'll send me the recording tomorrow, I think.
Yeah, for recording, it takes time because the recording gets compressed first and then it is uploaded. The file,
PDF file I can print now, yeah?
here it comes in 1 minute. Recordings, ICAEW SBM Ravi working file. Save here. Here it comes. Okay.
Okay. Thank you, sir.
Okay, so we'll continue tomorrow.